Good morning, good afternoon, good evening, based on where you are. Welcome back to yet another episode of the weekly market update with Irfan Khan and Joseph Di Virgilio.
Thank you, thank you. I love this stupid, sound effect.
Yeah, you kind of take yourself too seriously all
I
the
know.
time.
What investors must know this week. We are doing this on a Tuesday as opposed to doing this on Sunday because while I was traveling for about a month last month, this time is Irfan's turn to be traveling. He's traveling around Europe, and
Yeah,
he has arrived to destination, and good to know that he's ready and willing to keep going at this.
absolutely, absolutely. So yeah, we had to delay this a little bit, but we haven't forgotten at all. So here we are. And Joe, unless you want to start with something else, I can
No,
go ahead with the
we're gonna get to
second.
whatever the market has done in the last week and in the first 2 days of this week. So yesterday and today, which today just starting. But before we get to all the market updates and economic data and what to expect, we always start with the statistic of the week. Pardon me, and that's all yours. Go ahead, Itfan.
Yeah, and the statistic of the week is titled Severe Capital Destruction this week, which is to say roughly 40% of all stocks since 1980 have suffered a permanent, unrecoverable crash of 70% or more from their peak values. This is crazy, Joe. Tell
Yeah,
us.
and like every single time we discuss our statistic of the week, it's another point that points to the fact that investors must always be diversified with stocks and never, try to pick the winners because you don't know what may happen. And with this severe capital destruction statistic, there are a bunch of stocks, 40%, of just almost a half of stocks that have not recovered since the 1980s high. And so even more of a reason for investors to be constantly diversified.
Yeah. Okay. Okay.
It's very important. I mean,
So what's happened in the past week and the first session and a half of this week?
yesterday, yeah. Well, I'm going to go look at my notes a second so I can tell you what happened. So the final days of July and the opening session of August showcased a strong market broadening with cyclicals and rebounding tech heavyweights leading the charge. The Nasdaq was up 1.6%. That includes yesterday's close, that's Monday, August 3rd or the 4th, the 3rd, that's correct. The S&P 500 was up 1.05%. The Dow Jones Industrial Average was up 1.32%, claiming a new all-time high. Well, the key market drivers were the Fed's hawkish hold. The Federal Reserve kept the federal fund rate target range unchanged to 3.5% to 3.75%. However, the decision was marked by a rare 9-3 split. So three of the policymakers were in favor of a rate hike instead. Chair Kevin Warsh signaled a higher for longer rate stance, keeping a September hike firmly on the table if sticky inflation pressure persists. Cooling GDP and personal consumption expenditure data painted a mixed picture in the United States. Q2, so second quarter 2026 GDP grew at an annualized 1.5% as opposed to the 2.1% which was forecast due to an import surge and reduced government spending. Conversely, the Fed's preferred inflation metric, the core PCE, price index cooled slightly to 3.3% year over year in June, offering some relief to equity investors. U.S. manufacturing activity expanded in July at the fastest pace in more than four years, as demand remained strong. Production surged and firms added workers. This, according to the Institute for Supply Management July manufacturing gauge, which it says it rose 55.6, its highest since May of 2022. Now, reading above 50 indicates growth. Okay, so it means that the economy stays and it remains in good shape. But Susan Price,
There's some moderate growth.
yeah, absolutely. Although the 1.5% GDP print, which was caused by other factors within the equation. Susan Spence, who's the chairman of the ASEAN Manufacturing Business Survey Committee, she said sustained demand more more certainty around tariffs and expectation that war-related disruption would fade. Sorry, had tipped companies towards hiring. Now, this is the thing. What's a question I have is all of this was based on the fact that we've had a 5 month war with Iran, and but by the very first after the first couple of weeks, we were in a quote unquote ceasefire. So there was optimism about that. And so I think that even this is going to be somewhat of a, just like the CPI print that we had a couple of weeks ago, which showed that there was a better than expected inflation number. I think this is going to be another one of those shocks, because there was expectations that the war was over. People, corporations started hiring, and then next thing you know, here we are, we're still in a war. So the last burst of hiring in September 2023 lasted 1 month. So that's kind of what Susan Spence says now. She says that we saw this happening in 2023, but that lasted only a month. So I'm in the camp of this being the same thing again. So one other thing that happened was we had corporate earnings and sector shifts. The magnificent seven. Oh my, I can't get that word right ever. Magnificent seven. It's really one of those words.
Magnificent seven.
Yeah, the magnificent seven rebound after dealing with an AI-related pullback early in July, and we also had a software correction starting June. Mega cap tech staged a dramatic recovery. Over a 3-day trading window ending Monday, which was yesterday, the group added about $1.7 trillion market capitalization. Amazon breached a $3 trillion market value or market cap for the first time, while Meta, which gave disappointing numbers last week, was down about 10 to 12%, rebounded, was up 6 or 7% just yesterday. Alphabet and Microsoft posted strong post-earnings gains. Sector leadership, consumer discretionary names led the weekly charge by 4.74%, accompanied by communication services. Energy equities initially outperformed due to high oil prices, but pulled back sharply on Monday as crude slumped again because Trump announced again, what was this, the 50th time since the war is over that the war started, that the war is over. Okay, but whether one wants to believe that or not, that's entirely up to the listener. I am skeptical of this again. Treasury yields. So the 30-year flirted with 5.28%. That is a 19-year high, and that brings us back to 2007. So,
ouch.
And that was like on easing geopolitical risks. The problem here is Trump is stuck because now he has this quagmire with Iran, and at the same time he can't keep going as he wishes because there is he has no choice because there's credit agency downgrade risk. So there was also another thing that happened, the yen intervention. In currency markets, a joint currency intervention by the United States and Japan officially successfully propped up the Japanese yen after it hit a multi-decade low against the dollar. So there's been this carry trade going on. This differential between the yen versus then buying into treasuries. So as markets move forward into August, institutional eyes shift to U.S. non-farm payroll and unemployment reports due on Friday. The unemployment report is due on Friday, which is in 3 days. Continued corporate earnings from key players like Advanced Micro Devices and McDonald's. Official confirmation regarding diplomatic progress over Middle East shipping lanes. So now I want to go back to Iran again, for the
I guess we'll hear more about the things you just mentioned in the next few days.
Oh, definitely. We definitely will. So there's this Iran situation. Trump always says we're talking. They're ready to sign a deal, and we've heard that over and over and over again. Obviously, he wants this over. He started this, and now he realizes he shouldn't have, and he's regretting it that very much. And as soon as he says stuff like that, Iran bombs a ship or attacks an ally in the Gulf. So, and he needs this done. And so, not only does Iran have leverage over the strait itself, but it has leverage over the United States Treasury market, because the more this goes on, the more yields are going to, have risk of going up, and that could under ultimately, cut the legs off the United States, the United States economy. And so, he says war is over to me, but except for the war part, that's what I think Trump is saying. War is over except for the war part. Trump has been sued again due to tariffs once again. 25 states and an avalanche of corporations have just initiated a new lawsuit against him. So, stack of the week, follow up on BYD. We actually rebought BYD, tickers BYDDY, the largest.
And with that, we take the opportunity to remind you that this is not investment advice. This is just something that we like, that we are following. And if you are at all interested in BYD that we're just talking about now, you should first and foremost consult with your financial advisor to see if this is something suitable for you and in line with your investment
objective.
Objective.
Correct. Yes. This is by no means investment advice. Talk to your financial advisor. This is our portfolio that we like to discuss. And BYD is the largest EV manufacturer in the world. Took over Tesla a year and a half ago. With what's going on now within the Middle East, especially in Asian markets, have seen a pickup in EV sales. Obviously, they're very sensitive to gasoline, and so look at Japan alone. Takes up 90% of its oil comes from the Strait of Hormuz or so. So Asian markets have seen a big pickup in EV sales, and I would reckon it's going to continue even in Europe. BYD has been taking Europe has been taking Europe as a market, and they're doing quite well. Another company that I liked up until recently was NIO. Remember NIO? But they're struggling a little bit. So I think that pricing power is BYD for now, and so I think that this stock is poised to do well in the near future, because of geopolitical risk, and because people start to realize, what. Do I need to have this problem if something, some geopolitical situation happens again? I don't want to have a problem with oil, so or gasoline. So people want to, it's more of a safety net to have an electric car nowadays than it was a year ago or even 5 months ago, really, before this Iran bullshit started. That's really it for me.
Got it. Okay. Well, still, that's a pretty densely packed session we just had, and I guess we'll have more to share with some of the things we just briefly touched upon this week when we have our next episode this coming weekend.
You want to thank everybody for following us. By the way, if you do us a favor, that's the only thing we ask is to subscribe to the channel, like, comment, and share. We've been growing slowly and steady, and we would like to continue doing that. And and by the way, please feel free to comment and ask us, questions, and push us to talk about things that you might want to hear that you want us to cover. We're here for that as well.
Right. Absolutely. We're not here just to sort of talk about what we are interested in, what we might think is interesting, but obviously this has to be something that suits your liking, that is to your liking, that suits your interest as well. So by all means, please, do come and ask us questions, and we'd be happy to talk about those topics as well.
Beautiful. Thank you very much, and we'll see each other next week or at the end of the week.
Take care.